Welcome to HerPath to Profit, the podcast where women business owners get the tools, knowledge, and confidence to build thriving businesses and lasting legacies. I'm your host, Jennifer Engle, a CPA and fellow entrepreneur. Today's episode is packed with timely info every entrepreneur needs to know. We are going to be breaking down the biggest changes from the newly signed 2025 Tax Act, and more importantly, what these changes actually mean for you and your business. So grab your coffee, take a walk, or settle in with your favorite notebook, and let's dive in. So let's start with the big picture. The 2025 Tax Act is one of the most significant tax reforms in recent years. It's right up there with the 2017 Tax Cuts and Jobs Act. This act is going to be designed to provide more certainty, simplicity, and opportunity for business owners, especially for women entrepreneurs like you. So to get started, let's just talk about some of the key highlights. First off, there's going to be a permanent lowering of the tax rates. So the lower tax rates from the 2017 Tax Cuts and Jobs Act, they are going to be permanent. That means that the individual tax brackets are going to be staying at 10, 12, 22, 24, 32, 35, and 37% instead of reverting back to the higher pre-2017 rates. So big win for everybody. And then in addition to the rates being lower, it actually takes more income to jump tax brackets, so also another win. For many small business owners, especially those operating as sole proprietors or pass-through entities, this is going to mean more predictable and often lower tax bills for years to come. So cheers to that. The next thing is the enhanced standard deduction, which is here to stay. The standard deduction is also going to be getting a boost. So for 2026, it's going to jump to $31,500 for joint filers and $15,750 for singles with an annual inflation adjustment. This is great news for entrepreneurs who don't itemize deductions. It's going to mean less paperwork and more savings. Then there's the qualified business income deduction. This has also been extended and enhanced. So the popular 20% QBI, qualified business income deduction, is now permanent, which is amazing. And it's also going to come with a new minimum deduction of $400 for active business income, but there's going to be a minimum of a $1,000 QBI requirement. So you need to have at least $1,000 of qualifying business income in order to get that $400 deduction. The phase-in thresholds are also higher, $75,000 for singles, $150,000 for joint filers with inflation adjustments. And active qualified trader business is defined as one in which you materially participate. So we definitely want to make sure that you're materially participating in your business, and we're documenting these things so that you can qualify for this QBI deduction as long as you meet the other criteria as well. This is going to be a big win for women running their own businesses, whether you're a consultant, a shop owner, or a freelancer. So this is awesome. Then we have the Section 179 expensing and 100% bonus depreciation. Another win here. The Section 179 expensing limit is now $2.5 million, and the phase-out threshold is $4 million, which are both indexed for inflation, so huge increases there. Plus, the 100% bonus depreciation is being made permanent. So translation, you can write off the full cost of qualifying equipment in the year that you buy it, making it easier to invest in your business's growth. A really big win there as well. And there's a new provision that's going to allow 100% depreciation deduction for certain real property used as an integral part of producing tangible personal property. This is going to be a huge incentive for manufacturers and makers to invest in their new facilities because this could result in a very large tax deduction. Next, the limitation on excess business losses for non-corporate taxpayers is now permanent with updated inflation adjustments. This means you can't deduct business losses above $250,000 or $500,000 for joint filers in a single year. Excess losses are going to become net operating losses that can be carried forward for future years. Paid family and medical leave credit has been extended and enhanced. The paid family and medical leave credit is now permanent and it's more flexible. Employers can choose a credit based on premiums paid for insurance policies that are providing paid leave or the actual wages that are paid for paid leave. And the definition of eligible employee has been expanded. The employer-provided child care credit has been enhanced. The credit percentage for qualified child care expenditures is increased to 40% for regular businesses and 50% for eligible small businesses, with higher annual maximums and expanded eligibility. So if you are providing child care to your employees, this is a huge benefit for you, as you're going to be getting a pretty large tax credit to help cover the cost of providing that benefit to your employees. There's new deductions for tips, overtime, and car loan interest. Big talk around this. For 2025 through 2028, there's a deduction for up to $25,000 in tips and $12,500 in overtime pay, double that for joint filers, plus up to $10,000 in interest on new car loans for U.S.-made vehicles. So huge deductions here for some of your employees and possibly even for you, depending what industry you're in. And then the child independent care credits have been enhanced. The child tax credit is now $2,200 per child and indexed for inflation. And the child independent care credit is more generous with higher income thresholds and credit rates. There's going to be new tax-deferred investment accounts for children. The Act creates new tax-deferred investment accounts for children that are going to be called Trump accounts. The contributions are going to be limited to $5,000 annually, and there's a federal pilot program that's going to provide a $1,000 contribution for every U.S. citizen that's born between January 1, 2025 and December 31st, 2028. So all those newborns are going to get a $1,000 contribution from the government to put into these Trump accounts. There is now a credit for contributions to scholarship granting organizations. There's a new non-refundable income tax credit for individuals who make contributions to qualified scholarship granting organizations, up to $1,700 per taxpayer per year. So this is a great way to support education and getting tax benefit for it. So if this is something that you're interested in, this could be a huge benefit for you since it's a credit versus a deduction. Changes to the premium tax credit. There are several significant changes, including elimination of the repayment cap, new eligibility definitions, and stricter verification requirements. So if you or your employees use the premium tax credit for health insurance, you really need to make sure you're reviewing these changes. The moving expenses, the suspension of the moving expense deduction is now permanent for most taxpayers except certain military and intelligence personnel. And then there needs to be some caution around claiming the employee retention credit or the ERC credit. The Act imposes new penalties and limits on employee retention credit claims with increased enforcement and a longer assessment period for ERTC-related amounts. So really take caution around that. So now I just spit off a bunch of information. There's a lot more in the Act. A lot more is going to be coming. But for what we've talked about so far, let's just get a little bit practical now. So how can you, as a woman business owner, make the most of these new rules? Here are some actionable strategies that you could be thinking about. First, look at maximizing the qualified business income deduction or QBI deduction. To do this, you want to make sure that you are materially participating in your business, meaning you're actively involved in the operations. This is especially important for women with multiple ventures or side hustles. You're going to want to make sure that you keep good records of your hours and activities to support your deduction. This is an excellent deduction that you want to be able to take advantage of. The new minimum deduction and higher phase-in threshold mean more women can qualify for this deduction, but you must have at least $1,000 in qualified business income and meet the active participation test. So make sure you're doing those two things. And then if your income is near the phase-out threshold, you really need to consider different ways to decrease your income so that you can qualify for this QBI deduction. Some of those ideas could be increasing your retirement plan contributions, taking advantage of the 100% bonus depreciation in Section 179 that's now available, or it could be looking at health savings accounts that you could be putting money into if you have an eligible health insurance plan. There's a lot of things that we could be doing to try to decrease your income for the year so that you could qualify for this QBI deduction if you're near that phase out threshold and it makes sense for your business. The next strategy is really right now is a great time to be investing in your business. With that 100% bonus depreciation and higher Section 179 limits, you should consider upgrading your equipment, technology, or workspace. So, for example, if you're a photographer, maybe buying that new camera or computer could be fully deductible in the year of purchase, which could be, a little bit of tax savings for you. Or if you have other large purchases you've been thinking about, right now could be a good opportunity to take your earnings and reinvest them back into your business if it's going to help your business grow. And then Section 179 is now allowing up to $2.5 million in expensing with a $4 million phase out. This is a huge opportunity for businesses looking to modernize or expand. And if you're in the manufacturing or production industry, the new 100% depreciation election for real property used in producing tangible personal property is going to be a game changer. Couple things to keep in mind. Construction must start between January 20th, 2025 and December 31st, 2029, and it must be placed in service before January 1, 2031. But this is a great opportunity for anybody investing in real property for the manufacturing industry. There are some other rules that you'll need to make sure that you're following, but this could be a huge deduction for a lot of people in this industry. And then look at leveraging family-related credits and accounts. If you have children or dependents, claim the enhanced child tax credit and dependent care credit. And if you pay for daycare so you can run your business, keep receipts and documentation to maximize your credit. Consider opening a tax-deferred investment account or a Trump account for your child. You can contribute up to $5,000 per year, and the government's going to seed $1,000 for any newborns between 2025 and 2028 if they're U.S. citizens. These accounts must be invested in a diversified U.S. equity index fund, which a financial advisor can help get you set up and get you rolling. And it's going to grow tax deferred until age 18 when the funds would then be able to be accessed. So it could be an opportunity to invest some pre-tax dollars and set them aside for your child. Then we can also consider being charitable strategically. So take advantage of the new credit for contributions to scholarship granting organizations. You can claim up to $1,700 per year, but you need to be sure to check that your state participates and don't double count the contribution as a charitable deduction if you're taking it as a credit. But if you really want to support state education, this could be a great credit for you. And then you also need to plan your charitable giving to maximize the new 0.5% AGI floor and the permanent 60% ceiling for cash gifts to public charities. So planning how you're going to do your giving for the year is also very important. Then take advantage of new deductions. So if you or your employees receive tips or overtime, or you're buying a new US-made vehicle for your business, plan to claim these new deductions. For example, if you're a salon owner, you can now deduct your tips received up to $25,000, and a rideshare driver can deduct car loan interest on a new vehicle if it's US made. So some good deductions to think about taking advantage of that could be helpful for you and your business. And then plan for paid family and medical leave and childcare. The paid family and medical leave credit is now permanent and more flexible. Employers can choose a credit based on premiums paid for insurance policies providing paid leave or based on the wages that were paid. And the definition of eligible employee has been expanded. Then there's also the employer-provided child care credit being enhanced with higher credit percentages and maximums. So it was 40% for regular businesses, 50% for small businesses, and there's expanded eligibility for small businesses and third-party facilities. So once again, if you're providing child care to your employees, definitely need to look into that credit. And then we need to stay on top of the health insurance and premium tax credit changes. The premium tax credit rules are stricter, with the repayment cap being eliminated and new eligibility definitions. If you or your employees use the premium tax credit, you really need to review your eligibility and be prepared for new verification requirements. Then you need to also watch your losses. The limit on excess business losses, it's now permanent. So if your business has a tough year, you can only deduct up to $250,000 or $500,000 joint in losses if you're a non-corporate taxpayer. The rest becomes a net operating loss that can be carried forward to use in future years. And lastly, you need to be cautious with the employee retention credit claims. The employee retention credit is under increased scrutiny with new penalties for improper claims and a longer assessment period. So if you're considering an ERC claim, make sure you're consulting a qualified professional, not one of these ERC mills, and ensure that you have thorough documentation for claiming this credit. So now let's bring these strategies to life with just a few examples. So let's just say you are Maria, you're a bakery owner, and you buy a new oven for $10,000 in 2026. You're going to be able to write off the full cost either using Section 179 or bonus depreciation, whichever makes more sense in your situation. That can help reduce your taxable income and free up cash for other investments or free that up to help pay for this new oven. Then let's say you're Jasmine, you're a freelance graphic designer and you're earning $80,000 in qualified business income and you're actively managing your business. You potentially could claim up to a 20% QBI deduction, which would ultimately reduce your taxable income by $16,000. Then let's say you are Lila, a salon owner, and you receive $15,000 in tips in 2026. You're going to be able to deduct that full amount, lowering your taxable income and potentially your tax bracket because your taxable income is going to be reduced by $15,000. Let's say Tanya, she's a mother of two, and she opens a Trump account for each child and receives a $1,000 federal seed contribution for each child. And then she's also investing $5,000 per year, which is ultimately building a tax-deferred nest egg for her children's future. So very cool thing that she'll be able to do there. Now, even with all of these opportunities, there are some pitfalls that we need to watch out for. First one being the SALT deduction cap is still applying. So the state and local tax or SALT deduction cap, it's been increased to $40,000 for 2025. However, it does phase out for higher incomes and it does revert to $10,000 in 2030. So if you are in a high tax state, you definitely need to pay attention to this and you don't want to overestimate your deduction in future years. You just need to really pay attention if your income is low enough to qualify for this or not, and that it is only available for a short period of time for that increased cap of $40,000. The miscellaneous itemized deductions, those are remaining suspended. Deductions for unreimbursed employee expenses, investment fees, and similar items, they remain suspended except for educator expenses. So don't count on these deductions returning. And then watch out for new reporting thresholds. The 1099 reporting threshold for payments to contractors is going to jump from $600 to $2,000. But you do need to make sure you're still tracking all your payments and collecting W-9s from your vendors because the IRS is increasing enforcement and penalties for non-compliance with this increase from $600 to $2,000. The personal exemption is gone except for seniors. So because they increased the standard deduction, they have now removed this personal exemption. So that personal exemption has been permanently eliminated except for a temporary senior deduction. So if you're under the age of 65, don't expect this deduction to return. A lot of energy credits are sunsetting. So if you're planning to invest in solar panels, electric vehicles, or other clean energy for your business, you're really going to want to act fast. Many of these credits are ending in 2025 and then some into 2026. So you do need to act fast on some of these energy credits if that was something you were planning to do. And not keeping good records with increased IRS enforcement, poor record keeping can lead to missed deductions, increased audit risk, and denial of certain tax benefits. Missing out on family employment tax savings, employing children or spouses in the business can provide payroll and income tax savings, but you need to make sure that the wages are reasonable and that they're properly documented. This really can save quite a bit of money in both payroll and income taxes if done correctly. Really keep that in mind. Failing to monitor legislative changes. Many favorable provisions are scheduled to sunset after 2025, so stay informed and plan for these changes to avoid any missed opportunities or surprises. Once again, caution around claiming the employee retention credit. The IRS is cracking down on improper employee retention credit claims. The 2025 Tax Act imposes new penalties for promoters who don't meet due diligence requirements, and it extends the assessment period for ERC-related amounts to 6 years. So if you're considering an ERC claim, make sure you have thorough documentation and make sure you're consulting a qualified professional. Don't fall for the aggressive marketing or too good to be true promises that these ERC mills have been doing over the last few years. Improper claims can result in steep penalties and headaches down the road that just are not worth it. Changes to moving expenses. The moving expense deduction does remain suspended for most taxpayers except for active duty military and certain intelligence community employees. So if you're relocating for business, don't count on a tax deduction unless you fall into these narrow categories. And then premium tax credit changes. If you or your employees use the premium tax credit for health insurance, be aware the repayment cap on excess advanced premium tax credit has been eliminated. So you will be responsible for any repayment of the premium tax credit. And new eligibility and verification rules apply. Lawfully present aliens must meet stricter definitions, and some groups are now excluded. Make sure you review your eligibility and keep up with new documentation requirements. So now let's just take a few minutes to go through some questions that maybe some of you have or could have. So let's just say I want to support education in my state. How does the new scholarship credit work? This would be a great question. So if your state participates, you can get a federal tax credit up to $1,700 per year for cash contributions to qualified scholarship granting organizations. Just remember that you can't double dip by also claiming a charitable deduction for the same gift, and that the credit is reduced by any state tax credit that you receive. Unused credits, they can be carried forward for 5 years. This could be a great opportunity to contribute or donate to some of these scholarship organizations to take advantage of this tax credit. So what's the deal with the new investment accounts for kids? The new Trump accounts, they are going to let you, relatives, or even employers contribute up to $5,000 a year for a child that grows tax deferred in a U.S. equity index fund. Plus, there's going to be a $1,000 federal seed money for children that are born between 2025 and 2028. And it is a great way to build generational wealth and teach kids about investing at a very young age. So it could be a great opportunity for you and your family to take advantage of if it makes sense for you in your situation. So now, how do I make the most of the enhanced childcare and paid leave credit? So if you offer childcare or paid family or medical leave, the credits are now bigger and they're more flexible. For childcare, the credit is up to 40% or 50% if you're a small business of qualified expenses with higher annual maximum. So if you are providing childcare to your employees, you are going to potentially get a credit anywhere from 40 to 50% of what you paid for that benefit to provide to your employees. That is a huge thing that you could be taking advantage of to help you cover the cost of paid leave. You can also now choose a credit that's based on insurance premiums or wages, and more employees qualify. These credits are going to help offset the real costs of these benefits and help you attract and retain talent, which is great for small businesses. Okay, next question. I run a small bakery and just hired my teenage daughter. Can I pay her and get a tax benefit? Absolutely. As long as her wages are reasonable and she's doing real work, you can deduct her pay and she may pay little or no income tax on her earnings. So this is a great way to move money from your tax bracket to your kid's tax bracket. And what's even better is that you're doing it with earned income. And depending on your entity structure, you can also avoid having to pay the payroll taxes, and depending on how old your daughter is and who the owners are. But there is a way to potentially not have to pay the payroll taxes, as well as there not being any income tax if what you're paying her is below the standard deduction amount. And then there's also the benefit, since there's earned income, she could actually take that money and invest it into a Roth IRA that where future earnings on that money would grow tax-free. So in the future, when she needs to take that money out in retirement, she would be able to do so without paying tax on any of those earnings. So if that investment doubles, the amount that it doubled by, she's not going to have to pay tax on it. I mean, it's a huge benefit for young people to take advantage of it. And if you have kids, this is an awesome opportunity. So the next question, I'm thinking about switching from an LLC to an S Corp. Is it worth it? Really, this depends on your income, business goals, and how much you pay yourself as a salary versus distributions. S Corps can offer self-employment tax savings, but you must pay yourself a reasonable salary and handle additional compliance. There's also some other considerations depending on where you live, what state you live in. There's different franchise taxes that you would need to be aware of when looking at sole proprietor, LLC, partnership, S Corp. You also need to think about what the type of business you're running. Is it more heavy in the real estate, not a lot of active management, or is it more in an operating business where you're going to have a lot of earned income, unlike what you may have with rentals? So really need to think about what type of business you have, where you live, what's your income, what's your wage need to be. All these different pieces can play a role. And then also making sure that you'd be able to handle the additional compliance. It's a very different tax code that you're following. So there's pluses and minuses to both. You need to talk to your tax professional that knows your situation to help you come to a conclusion as to which type of entity would be better. We would definitely be happy to help you with this. If you wanted to jump on a call with us, we can walk you through this, get to know what your situation is, and help you make a decision is it worth it to elect to be an S Corp? And the last question, what's the best way to keep up with all these changes? Subscribe to reputable tax newsletters, work with a knowledgeable CPA. We'd love to work with you, and continue to tune into our podcast here, HerPath to Profit, for regular updates. We are happy to help and happy that you're here. So action steps and resources. Here's your action plan to make the most out of the 2025 Tax Act. First, review your business structure to see if a change could save you money, especially with the new QBI and Section 179 rules. And then there's also a lot of rules that changed within the C Corporation. So really reviewing your business structure could be worthwhile at this point in time. Maximize retirement, health, and child investment accounts. Take advantage of all the new and enhanced options that are out there from the Tax Act. Upgrade your record keeping, especially with the new 1099 thresholds going from $600 to $2,000, and then being aware of the stricter IRS enforcement. So make sure you're still getting those W-9s so that we can file those 1099s at the end of the year. Plan your charitable giving. Consider the new scholarship credit and the new AGI floor that is now out there, and just need to really think about your charitable giving and what makes sense for you. Claim all available credits and deductions, from childcare to paid leave to business investments. There's lots of options out there, so make sure that you're claiming all that makes sense for you and your business. Be proactive about compliance, especially with employee retention credit, premium tax credit, and moving expense changes. And then lastly, monitor legislative updates. Many provisions have phase-ins, sunsets, or require state participation, so make sure you're monitoring those updates and make sure that you understand them. Some resources that you can use is the irs.gov for official forms and guidance, the Small Business Administration for planning tools, and keep tuning into our podcast here at HerPath to Profit, where we will keep doing more deep dives. Ladies, the 2025 Tax Act, it is full of opportunities, but also a few traps. So with the right strategies and a proactive approach, you can keep more of what you earn, invest in your dreams, and build a business that supports your life and your legacy. Remember, you're not just building a business, you're building a future for yourself, your family, and your community. The tax code, it may not always feel exciting or inspiring, but understanding it, that is powerful. So if today's episode gave you clarity or sparked ideas, here's what you can do next. Hit subscribe so you never miss an episode. Share this episode with a fellow business owner. Leave a review. It helps more women find this podcast. And if you're ready for personal support, To make sure that you're taking advantage of every opportunity in this new law, book a discovery call at hertaxgps.com. We look forward to helping you and supporting you in any way that we can. Until next time, keep leading, keep learning, and keep profiting on your terms.